What's up, everybody? I'm Leaf with Adaptable Wealth, and I'm sure I don't have to tell you, the markets are absolutely getting crushed after Donald Trump indiscriminately levied tariffs on pretty much every single country in the world. The S&P 500 was down 10% in just the last week. And given the unpredictable actions that this administration has taken in just 3 months that they've been in power, it's reasonable to expect that this type of volatility continues for the foreseeable future, possibly into 2026, and if we're going to be honest with ourselves, it is possible that we continue to get this type of volatility in the markets throughout his presidency. If you've invested for long enough, you will eventually realize that there's always a reason to stay out of the stock market. There's always a reason to sell stocks. There's always a reason to put your money in less risky assets like treasuries or something like that. However, what you'll see on my screen here is a chart of the world stock index from 1992 to 2022. And what you'll notice is that there's always something to worry about in the market that should be causing people to sell, dragging down the market, causing it to crash, or just staying stagnant for years and years on end. We had Black Friday. We had the Asian financial crisis, the Russian financial crisis, the dot-com bubble, 9/11, the wars that came along with that, the global financial crisis. A lot of people don't remember that the U.S. was downgraded from AAA status. We also had the Brexit vote, and in Trump's first term, we had trade wars. A lot of people don't remember that. They definitely weren't as widespread and as rash and unpredictable, but we definitely had trade wars. We had COVID and all the lockdowns that came along with that. We've had wars throughout this entire 30-year period. We just went through global inflation, which crashed the market in 2022. And what has happened pretty much every single time is that the market over a long enough period of time has bounced back, ended up higher than it was before, and often meaningfully so. History has shown over and over and over again, when you get these temporary events that cause market pullbacks of 10, 15, 20 or more percent, it is almost always a great time to buy. There have been a couple of instances throughout the history since 1900 where it might take 5 to 10 years for the market to get back to where it was before. But if given a long enough period of time, 10, 15, 20 years, you're almost always better off being invested in stocks because the market is going to end up higher than it was before, and often meaningfully so. So that brings me to the approach that I'm taking with the current, what I perceive as temporary event that is giving me some very attractive entry points in some very high quality companies. My approach is going to be a little bit different than what you've heard from other people on YouTube recently. Because of my significant tech exposure, it makes sense for me to focus on companies that are trading at or below market multiples because they've already been beaten down so much that they offer a better margin of safety and risk-reward ratio. Don't get me wrong, I have no problem with adding tech here. As you'll see on my list here in a second, there are some very high-quality tech companies that are trading at significant values to what I estimate as their intrinsic value. However, there are also several names on there that are trading at significant discounts to the market that are decent, and even a few that are high quality companies. So my logic is, why wouldn't I go after the companies that are high quality that are trading at below market multiples? It just seems like a smarter investment to make for my situation. If you can't handle this type of volatility, or your investing time frame is shorter than, I'd say, about 10 years, then there is absolutely no shame in holding short-term treasuries or other lower volatility, less risky assets. I will caution you though, the 4% that you're going to get from short-term treasuries is not going to exceed inflation enough to meaningfully grow your wealth in real terms over long periods of time. Okay, let's dive into some stocks. Over the last couple of weeks, I've gone through every single one of the companies that I either own in my portfolio or I have on my watch list in order to calculate an intrinsic value and to determine which ones are the best discounts in the market right now and are targets for my capital. Out of the 41 names that I valued, we have 14 that are considered undervalued or trading at a 10% or more discount to their intrinsic value. We have 12 names that are trading within 10% of their intrinsic value, and the remaining 15 names are trading at more than 10% above their intrinsic value. So the stock that I see as most undervalued in the market right now is PayPal. I estimate that they're worth $94 per share, and they're trading at a $59 per share for a 60% discount. If you were to listen to investors in the market right now on PayPal, you would expect this to be a company that is in decline. That is not the case. They are going through a turnaround right now, but they're still growing at that 7 to 8% range, and they're trading at an 11 forward PE. When the market is trading in that 19 to 20 PE range, this company is trading on an earnings basis almost half the value of the market and a 10% free cash flow yield. If we look at the SBC adjusted free cash flow, they generated about $5.5 billion in free cash flow on $32 billion in sales. That's about, what is that, 16% free cash flow margin, which isn't great. I prefer to see something over 20, but it's not bad. It's not like they're losing money or anything like that. And the thing that really attracts me is that they are buying back their shares hand over fist. Their management realizes how undervalued their shares are, and they've been buying back 5 to 6% over the last couple of years, which is exactly what you want management to do when you have a company that is this undervalued. Now, I don't expect them to be buying back shares at this rate in the future. It's probably going to normalize in that 1 to 2% range. But in the time being, while they're going through their turnaround, their share buybacks are going to put a very nice floor under their earnings per share to help support the stock price. As a matter of fact, this is the company that I've been adding the most to my portfolio. I added about $4,000 so far, and I'll probably add another $2,000 or $3,000. Having said that, PayPal is not the greatest company. For me, this is not a long-term buy and hold position. This is more of an opportunistic, hey, this company, everybody's leaving for dead, offering a 10% free cash flow yield, trading at half the earnings multiple of the market. I'm going to go ahead and take advantage of that opportunity, but if this company gets back up into that $85, $90, $100 range, I'm going to be taking my profits. This isn't a long-term buy and hold for me. It's more of a short-term opportunistic purchase. The second most undervalued stock on this list is Nvidia. They're currently trading at 96 bucks. I estimate that they're worth 148 for a 54% discount to their intrinsic value. And boy, how the times have changed. Just 3, 4, 5 months ago, semiconductors were on top of the world, but they've been absolutely obliterated over the past few months, and Nvidia has not been spared. First, we had DeepSeek, which caused the market to question the rationality of such large capital expenditures by big tech, but it also caused investors to question the need for Nvidia's chips for AI in the first place. And then the tariffs were basically gasoline on the fire because they were so widespread that they included Taiwan, which is where TSMC resides. TSMC is Nvidia's foundry. They produce the chips that Nvidia sells, and these tariffs are going to cause a rise in production costs, which will cut into Nvidia's margins. But after this drawdown, they're trading at a very reasonable price given their growth prospects and their profitability. They're trading at a 21 forward PE and a 2.4% free cash flow yield, which is right around where the market is trading, but they're expected to grow earnings 5 times more than the market this year and 2 times more than the market next year. And this is why Nvidia is a great buy right now. It's probably going to be a very bumpy ride, but as long as you can stomach the volatility and you can hold it for the long term, this is about as good an opportunity as you're going to get to buy such a high quality, high growth company at these prices, which is the reason why I caved yesterday and I started a small position in Nvidia, and I'm likely to add to it over the next month or two at prices at around or hopefully below $100 per share. The third most undervalued stock on this list is Uber, trading at 65 bucks. I estimate that it's worth 96 bucks for a 47% discount to its intrinsic value. Uber is another company that I recently added to my portfolio because it fits my strategy of buying companies that are trading at lower than market multiples but are growing faster than the market. I did a deep dive on Uber a couple of months ago, so if you're interested in any of its details such as its moat, its risks, what I think about it, etc., feel free to go check it out on my YouTube channel. Next on this list is ASML, the high-tech semiconductor machine manufacturing company. They're currently trading at 595 bucks. I estimate that they're worth 848 for a 42% discount to their intrinsic value. This company has an extremely wide moat based off of intangible assets and switching costs. They have a practical monopoly on the high-tech EUV lithography machines that are required to make the most cutting-edge chips around today. This is another one that I recently did a deep dive video on, so if you're interested in any additional details about this company, feel free to go check it out on my channel. I suggest that you do because there's some pretty big risks that every investor should be aware of. Now, I already have a full position in this company, so I haven't been adding during this pullback, but if it continues to fall, I'm eventually going to take a bite and buy some more. Adobe is another one that I've been adding over the past couple of months. It's currently trading at $340 a share. I think it's worth $464 for a 36% discount to its intrinsic value. I've repeatedly called this out as a gross undervaluation in multiple videos on my channel over the past year. If you're interested in my ideas about the disruption of their business model, feel free to go check those out. But in summary, I think the concerns about the disruption of their business model are overblown. I think Adobe will be just fine. In fact, they're already monetizing their AI offerings. And when I can get a high quality company trading at a 16 forward PE and a 5% free cash flow yield, again, both of those are below market multiples, I'm going to take advantage. Other than Nvidia, we got 3 other big tech names on this list. We got Amazon, we got Google, and we got Meta, all of which are trading at about a 30% discount to their intrinsic value. I don't have to say much about these companies. They're fantastic buys at these prices, especially if you're a long-term investor. I've added a little bit of Amazon during this pullback, but I haven't touched Google yet because it's already my top holding at 11% of my portfolio, and I don't want to increase my exposure given its risks. Next, we have the apparel companies with significant exposure to the Asian countries, all of which are trading at about a 30% discount to their intrinsic value. We'll start off with Lululemon and Deckers, both of which have been hammered because of tariffs. But if we get any relief on the tariff front, these two companies are going to take off, both of which are trading at about a 15 to 16 forward PE and a 5 to 6% free cash flow yield. They're growing their revenues over the last couple of years around 12 to 15%, although that growth rate is expected to slow. These are not the greatest companies. They will be tossed around with tariff news, but in my opinion, these are good long-term buys at these prices. And then there's Nike. They're also in the same boat as Lulu and Deckers in terms of the tariff impacts, but they're also dealing with the after effects of a mishap in their distribution strategy, which will take some time to work out of. I did a deep dive on Nike last year, so if you're interested in my thoughts on this company, I encourage you to go check that out on my channel. That leaves 3 more companies in the undervalued section. These 3 companies are fantastic companies. They're significantly undervalued. They're great long-term buy and hold stocks. And let's start with Arista Networks. It's currently trading at $70 a share. I estimate it's worth $90, so it's trading at about a 30% discount to its intrinsic value. Arista is a high-growth, wide-moat company that has taken over the #1 market share in the high-speed network management market. They compete with the likes of Cisco, Juniper Networks, Dell, and HP. And their moat is underpinned by some very strong switching costs. This is one of the stocks that even after this pullback is trading well above market multiples. But given the fact that they're expected to grow revenues in 19% in each of the next 2 years and their great profitability, I find that my valuation assumptions are quite reasonable in my opinion. My base case is about where they're trading right now with 18% growth and a 30% multiple. Historically, they've traded in that 40, 50, 60 PE ratio range. So if during this panic they're trading at my base case, I think that is evidence that my value estimate includes a very good margin of safety. This is another one that I did a deep dive on, and there is some customer concentration risk with this company, so I encourage you to go check out that video. But if there's one stock on this list besides Nvidia that can 3, 4, 5x over the next 5 years, it's Arista Networks. I'm not buying right now because I already have large positions in Microsoft and Meta, and those 2 companies account for 35% of Arista's revenues, and I don't feel like increasing my exposure to that dynamic at this moment, and it doesn't fit my current strategy at this time in terms of trading at or below market multiples. Next, we have Booking Holdings. It's currently trading at $4,164. I estimate that it's worth $5,300 for a 27% discount to its intrinsic value. Booking is the #1 online travel aggregator where they work with hotels and other providers to attract and refer customers to specific accommodations or services. They get referral fees whether or not the customer books a trip. Their moat is based primarily on a network effect and brand recognition. And I'm sure you've heard of many of their websites, such as Booking.com, Priceline, Kayak, and several other websites centered around that online travel booking niche. That's not it. Their strategy is what they refer to as a connected trip. So not only can you book a hotel or a place to stay, they offer flights, car rentals, restaurant reservations, and tons of activities to do while you're on your trip, all on one platform. And so far, they've been very successful with these additional offerings. They generate high returns on capital and profit margins. They've been buying back shares like there's no tomorrow. They're growing revenues around 10% per year, and they're trading right around market multiples on an earnings basis, but they're trading well below the market on a free cash flow basis at a 5.3% free cash flow yield. The only thing that I don't like about this company is its debt. I am considering adding Booking to my portfolio, and I'll be doing a deep dive on this company in the near future, so stay tuned. Finally, we have Salesforce. It's currently trading at $244. I estimate it's worth $295 for a 21% discount to its fair value. I'm sure you're all aware of what Salesforce does, so I'm going to be brief here. The things that make this a good buy right now, other than the fact that it's trading at a 20% discount to its value, is that it generates a 25% free cash flow margin. Its moat is underpinned by some extremely strong switching costs, and it's also established itself as a leader in the agentic AI market. They're trading right around market multiples, but if they can get this agentic AI thing to work and really catch on, then Salesforce could be a big sleeper at these prices. So that'll do it for the undervalued stocks. But what you see on your screen here, I have 6 companies that are highlighted in blue. These are companies that I'm keeping my eye on should they drop in price to an undervalued state that I would be looking to add them to my portfolio. However, given the fact that I have 15 companies that are most of which very, very high quality, and I can get 20, 30, 40, 50, 60% discounts on them, I'm not even considering any of these companies in blue until they're 20, 30% discounts. Why would I when I have better options? First, we have Hershey's. This company was trading at about $250 about a year or so ago until cocoa prices skyrocketed and really did some damage to their business. However, they are a very strong wide moat company. They have about a 30% market share in the candy market. They generate great returns on capital and profit margins. They're growing their dividend 15% over the past couple of years. Now, I don't expect this to continue at this rate because of the challenges that they're going through. And although revenues are at a standstill, they are such an efficient company that they've been able to drive 15% growth in earnings over the past couple of years through operating leverage and expense control. And best of all, they're trading at a 15 PE, a 5.6% free cash flow yield, and they pay a 3.3% dividend yield. So you're getting paid nearly as much as holding a treasury to wait for them to dig out of their hole. Next, we have CrowdStrike. This is the young, high-growth cybersecurity firm. I did a deep dive on this company, so if you're interested in my thoughts on this company, feel free to go check out that video on my channel. We have S&P Global, which is another company that I will be doing a video, a deep dive on as it entered into the fairly valued territory. Once it gets into the undervalued territory, this is a company that I'm going to be probably adding to my portfolio. It is a very strong company with some very strong diversified businesses. They operate in the rating agencies, data and analytics, and then they own several indices. The most notable one is the S&P 500 indices. So anytime that any type of investment firm or anybody wants to use the S&P 500 name or compare their performance to the S&P 500 index, they have to pay S&P Global a licensing fee. Next, we have Netflix. I'm sure you're all aware of Netflix. It is a very strong company. Their moat is underpinned by the first mover advantage and a very strong network effect. It also just entered the fairly valued section of my valuation. So if it drops another 15, 20%, I'll probably be adding this company to my portfolio as well. I did a deep dive on Netflix last year sometime. So if you want any more of my thoughts on that company, feel free to go check that out. And then all the way at the bottom here, we got two companies, Costco and FICO, which are very good companies, but they are severely overvalued. They would have to drop by 40 or 50% for me to even entertain them for my portfolio. Why would I when I have alternatives like NVIDIA and Amazon and Google, Meta, Arista Networks, Bookings, and Salesforce that I can get at 20, 30, 40 plus discounts. Well, anyways, that'll do it. I hope you guys enjoyed this video. If you got some value out of this content, please like and subscribe. It's a free and easy way that you can help me grow this channel. And I'm going to be leaving a link to my valuation file in the description in case you'd like to take a look so you can keep track of where these companies are trading in terms of their intrinsic valuation according to my assumptions. You can review my assumptions to see if you agree or disagree. Until next time, you all take care. I'll see you in the next one.